Welcome back to On Point, and of course, happy Africa Day. As you've just heard, words, of course, coming through then from President Cyril Ramaphosa as the leader of the African Union and indeed the leader of South Africa as well, sharing some kind words and really trying to get South Africans to embrace not just this day, but certainly this entire continent. We turn our attention to the markets though on this Africa Day, and we unpack the shift just a little bit more. We get into the Asian market in particular and we take a look at those, and we've certainly seen markets close out a little bit higher today, so a sense of positivity perhaps returning back into that market picture. And this is despite the fact that we've seen a little bit of tension between the United States and Beijing, particularly because of some issues around just who will in the end come out trumps when it comes to the issue of their trade war. There have been quite a few issues as well with regards to Beijing wanting to stipulate or put in place a few new laws in the city of Hong Kong as well, which the US has certainly said should not happen and will be met with great force as well. Right now it seems to be another tit for tat, this time not necessarily about trade, but certainly about other factors as well, which seem to have been plaguing the market. So many questions around those as well. The United States also then saying that they would actually add 33 Chinese firms and institutions to an economic blacklist for helping Beijing spy on its minority population, or because of ties to weapons of mass destruction and China's military. So that tells you really a sense then of the tit for tat that goes through between the nations themselves. The Shanghai Composite rising just over 0.1% then by close of trade. Japan's Nikkei index 1.73% higher there, as you can tell from that market index sitting at 20,741 points. The Hang Seng's at 22,952 points. Checking in on how things are faring out in Europe then as well. Well, it certainly has been an interesting time there. A few questions just around the standardization with regards to the growth as well that comes through when it comes to their QE program out in Europe as well. What happens from here on in? London is on a public holiday, however, a bank holiday there, and the United States too. So we're clearly not going to get that market movement there. So liquidity and perhaps trading should be quite thin on that front. So markets not necessarily enjoying quite as much positivity when it comes to the European front. On the local bourse, well, this is what the local index looks like. The JSE All Share is down around 0.1% today at this point in time in this lunchtime trade, with the resources being one of the bigger gainers. The platinum miners themselves doing the most gain there, 0.2% higher up in this midday trade. However, industrials not doing so well, while the banking stocks and the financials seem to be the biggest losers as well thus far, moving more than 1%, 1.33% lower, in fact, at this point in time. Onto your commodity picture then, some of these have certainly been of keen interest because they somewhat give you a measure of where the markets are faring right now, particularly when one looks at Brent crude. It is flat right now at $35.13 a barrel. Some would have hoped that perhaps demand comes back into the market, and if demand comes back, that means the price goes higher. But unfortunately, it's not necessarily to be, with tensions between China and the United States bound to impact things as well. So for now, it seems to be evening itself out. The price of platinum sitting at $827 a fine ounce right now, with gold sitting at $1,728 a barrel there. 17.65 for the South African currency against the US dollar. So a much better picture compared to where we have been, of course, beyond that 18 Rand mark. But we certainly would have hoped that things would get better. A sense of stability does come after S&P did decide on Friday to keep South Africa at its BB minus credit rating, which does certainly help somewhat. Of course, consider that in April they did downgrade us one notch down as well into non-investment grade, or continuing the junk status sort of notion for South Africa. So that sense of stability playing into the hands of the market somewhat. It's 19.27 for a euro. The British pound will set you back 21.53. Let's unpack all of this now and what exactly it means. I'm joined then by Bright Kumala from Vestac, who joins us via Skype as well. Then Bright, it certainly has been an interesting time for this market sphere. Generally though, it's still becoming a question of where do the US and China go to from here?
That fight between the US and China now, like you said, has escalated from just being trade wars, but by being, liberating the freedom, most importantly, of speech of, Hong Kong. And then obviously we come today we find ourselves, in the middle of a pandemic, and you have two of the biggest, trade partners, or the biggest, economies by dollars, fighting for, I don't know, it's no longer territory or trade wars, but freedom of another, sub-country of China. So it's very interesting to watch, and how that drives the markets going forward. Talking about the markets themselves, we know that the US and UK markets are not actually operating today, but today, like you said, the South African market slightly in the red, but we'll be seeing the resources 10 index basically up over 0.5% there, with the likes of Exxaro, Northern, and Anglo Plat, pulling their weight, which takes me to the year-to-date numbers. Again, it's names like Goldfields, Anglo Gold, Process, Naspers, Harmony Gold, Aspen. Those are the ones basically picking up the top 40, while Tsogo-san has basically almost lost, all of its value. Year to date being down, over 80% there, 86% to be exact. And, Invicta and Sasol also still down a lot year to date. And obviously, I cannot mention, the companies that are red year to date without mentioning property counters, the likes of, Redefine, Hyprop, Vugile, all of those down over 60% year to date, even after the big upsurge they've seen in the last couple of weeks.
Yeah, look, one looks at Tsogo-san, and they've been asking for certainly some form of help and assistance, right, when it comes to opening things up ever so slightly, even if it means internal borders get to open up a little bit and we get to have some sort of travel there. So that has certainly been quite significant for them. Let's talk about numbers to have come out today then, and it certainly gets interesting when one looks at Tiger Brands and says, well, South Africa's economy has been in the doldrums, so clearly Tiger Brands should also be suffering as well, and it clearly shows in their numbers, and they might even have quite a massive or significant job losses as well, so some hurt coming through for Tiger Brands.
Yeah, the fast-moving consumer goods, space provides a lot of work for the retailers, because they produce the item and send it for the retailer to sell along to us. But that lockdown has been there, and obviously, if you look at the likes of Walmart, for example, the things that they were moving the most wasn't groceries. It was actually, equipment to set up your home office, equipment to work out at home, etc., to basically enable that work from home environment. It hasn't been groceries. And obviously, Tiger Brands there, even though these numbers exclude lockdown, they are showing that, a rise of 2% in revenues, 50 to 15.7 billion rands. It's not looking good for fast-moving consumer goods companies. And, one of the biggest issue there was the very weak rand, considering the fact that everything in the fast-moving consumer goods companies depends on those input costs being down, including the likes of sugar and palm oil. And palm oil has been very expensive. They buy that in US dollars, and unfortunately a lot of the products there are going to be, input costs are going to be higher, meaning the products, even though it's moving at a normal pace, but it's not going to bring in a lot of revenues, unfortunately.
Yeah. The other part of this is you made note of the property companies, and just today we just got word that Redefine is going to fall out of the top 40 index. Should perhaps the top 40 itself have a lower market value anyway, considering how far down the market has gone?
Yes, I mean, the gold and platinum, PGM companies can only hold the top 40 for so long, right? We can't just depend on a few handful companies to hold on a very big index. So yes, we'll be seeing a lot of these property companies coming out of the top 40, unfortunately, and interesting companies, that have proven to be resilient, taking their space. But what needs to happen in South Africa is for the economy to actually come back to growth, to bring all the big businesses with it, and then we'll see the top 40 also change to mimic what is happening around the economy, and we'll see the rise basically in returns of the top 40.
Yeah, right. So you cut interest rates by 2.75 percentage points or 275 basis points then. What happens to the market as a whole when it comes particularly to buying things like bonds in particular? Should those still be something people get into? One would think that they have a lower interest rate, number one, because of their safety, and in a time like this, it gets even worse. Should we perhaps still be looking in that direction?
So yes, when it comes to interest rate linked products, investment products, you're talking about 32-day notice accounts, bonds, and anything basically that's linked to an interest rate. Yes, if the coupon is not guaranteed and fixed at a point, it will chase the lending rate, at least in South Africa, and that's what has happened to bonds. Yes, theoretically it's supposed to happen, and obviously physically it will happen. But because our bonds here in South Africa, because of our sovereign rating, they're still very much attractive than any bond you will find that is worth investing in with a trustworthy government in the rest of its counters, especially in emerging markets. So yes, the South African bonds have come down, but they're still offering relatively handsome returns as compared to the alternative that's out there, and most importantly, the alternative, which is the market. But what it does to markets is that it forces people that would have rather been, putting all their money in cash, they are forced to look at alternative like bonds or 32-day notice accounts, etc., that attracts some form of a return. Yeah. And at some point, it becomes, not so viable for you to put even your money in a 32-day notice account. So they're forced to go into bonds and in the market. So that should, in the medium term, drive the market upwards. But I don't see that happening here in South Africa because things just don't happen like that. We'll
certainly keep track of it and really see how things fare from that front. Will certainly get interesting. Bright Khumalo, appreciate your time there. Bright is from Vestact, and he had joined us then via Skype. Well, that brings an end then to our update here from the Johannesburg Stock Exchange. We'll be back again here tomorrow and hopefully give you more of a sense of how things are faring as well. Perhaps unpack that bond market just a little bit more and give you the latest on that front. From me, though, that is where the buck stops. My colleague Nompumelelo Siziba joining you right after this. Stay tuned. This is On Point.